Good afternoon and welcome to Midcap Radar, live from the CNBC-TV18 Motilal studio. I'm Vivek Iyer, and with me today is Mangalam Malu. Good afternoon, Mangalam. Not much to complain about. We started off the day on what was a very muted note, very weak handover, 5 consecutive weeks of declines. But post 11 a.m. especially, we've seen what is essentially a broad-based recovery across the entire market.
That's incredibly, well put, Vivek. We've seen a fair amount of selling. The street was anticipating a big, sell-off post, especially what took place on Wall Street as well. But the GIFT Nifty told you that maybe, we are in oversold zone and a bounce is imminent. A bounce is what happened. Now what we need to see is whether this sustains and builds on to that as well. Have we done ourselves with, the oversold zones and a relief rally that we've seen? Because it's struggling to go past that 24,700 mark. And the biggest reason for that is the Nifty Bank. Nifty Bank is currently underperforming. The Nifty has been taken higher by, you have the metals index as well as the auto pack. And both these indices are fairly volatile. And as a result of which, we have the India VIX. Despite the market being higher by almost 115 points, the India VIX has spiked in today's trading session. What the street would have liked is if the market continued to do well and the India VIX fell further from levels as well. But this is Midcap Radar. No complaints about the Midcap end of things. 1,600 stocks advancing for 1,100 stocks which are declining. The Midcap index itself up over 500 points. So let's go across to Hormaz, who is joining in with all the mid-caps that are moving around in trade today. Hormaz, there are a bunch.
Oh, absolutely. And the mid-cap index, as you mentioned, the market recovery is showing on the broader markets as well. They were the ones that were significantly bleeding during the sell-off last week. And starting off with some of the gainers that are not earnings reactions in today's session. Look at GMDC is up 8%. NetWeb, after its results, is continuing to build on to gains. UPL has recovered what it lost on Friday and a lot more. And Endurance Technologies has surged to the highest point of the day, 8% higher now on that stock as well. You take a look at some of the positive earnings reactions that have come in, some of them today, some of them over the weekend. Look at Sarda Energy now, 18% higher on that stock. Delivery is holding on to gains of 6%. MCX after the results and the stock split as well. And Ramco Industries just came out with results a few minutes earlier, saw a brief spike, but now is coming off those higher levels. And look at the negative earnings reactions on the flip side, and that'll give you an idea of TTK Healthcare. At one point fell 5% after its results. ABB India after its con call is down 6%, and Narayana Health too, another negative earnings reaction today. Stocks that are doing well on the volumes front, and they include the likes of CCL products. Look at Tata Investment, of course, the board came out with results and a stock split here as well. And JSW Energy trading 5% higher on today's session with very strong volumes. And lastly, stocks that are at a 52-week high today, and of course, it would not be difficult to find names here in today's session, especially eClerx Services is up 6%. Star Cement has moved to the highs of the day, and another 52-week high for this stock as well. Back to you guys.
Thank you so much for that, Hormaz. Whole host of stocks, especially the broader end of the markets, moving. Cement pack in focus. We have a large IPO too. And on the back of that, some positive rub-off seen across some names. Shree Cement too will deliver its numbers later today. Well, what's actually seen a bit of a recovery is the entire IT pack. Remember, the entire sector was actually under quite a bit of pressure in the week gone by. But today, what we've seen is a bit of a recovery. Names like TCS, Infosys, Wipro, all three of them near the day's highest point, even as we speak. Well, ABB India reported a weak set of Q2 CY25 numbers. The company's margins contracted, and the order inflow too came under pressure. We have the management with us, and this is something that we look forward to listening to.
So I think base orders definitely grew, right? So I think what was missing in this particular quarter was a large orders, what we had in the last year at the same time. And that's something which did not materialize in this particular quarter. And that's more driven by the fact about how speedily decisions get made up in the market, given the uncertainties of the other topics which are being dealt in the geopolitical level. So that's how we see that the market is behaving at this point of time.
So any particular segments in particular that are being impacted this time around? Is it largely, the impact is coming in on process automation, or, any specific segments that you like to highlight?
So as far as ABB portfolio is concerned, as you know, we are into 4 business areas: robotics, process automation, motion, and electrification. So typically our motion and electrification is a flow business, which essentially captures the mood of the market, how nation is building itself into infrastructure, industrial infrastructure, and the government capex which is formed in different areas. When it comes to robotics, it's pure manufacturing play, whether it's in automotive, electronics manufacturing, and I think that's where we continue to automate the industries. Process automation is an area wherein it goes into relatively in the core sector or heavy industry, which is prone to capex cycles, because sometimes the industrial cycle capex is up and sometimes is down. So we did see that there is a delay of decision making in the process automation area. And also around this year, we had fairly large orders in the traction area from railways and in the metros specifically, so which is not matching in the same quarter. So on a relative basis, you will see there's a decline there. So otherwise, we find that the market at a base level is pretty solid and robust, but at the same time, there's a sluggishness in decision making at this point of time.
Understood. So this sort of cyclical correction that you've alluded to, Sanjeev, I mean, how long do you think it can last from your experience over the last couple of years?
Back of 5 years of robust growth in our orders, revenues, as well as profitability, and I think that has been reflected very well. I think India's GDP has been growing about 6.5%, close to 7%. We have captured about 22% CAGR growth in last 5 years. So given that kind of scene we always have seen in our existence in the country as well as in the market always takes a breather after certain period of time, and I think that's what the market is doing at this point of time. And also given that lot of uncertainty is there in the market, especially on the trade front. So some of our customers they're taking a cautious approach, and we see that there are projects out there, but then there's a delay in decision making.
Understood. So the pipeline for the base orders as well as the large orders, how does that look like? Do you think that the order inflow trajectory that has slowed down now may pick up probably in the second half of the year? Is that something that you're working with?
They're tracking well. So that means that represents the base strength of the market, because channelization of the products and the solutions and the consumption in tier 1, tier 2, tier 3 markets is happening, and I think that's something which is working well. On the larger side, I believe we will say that we wait for another quarter and see how market grows, because some of the orders which should have been decided in the previous quarter, they have been kind of supposedly moved in the next quarter. We see that how the realization takes place, and then we'll see how the traction starts developing. So we typically take a view very close to when the customer changes their kind of behavior in terms of decision making, and then will we take a move whether the momentum is coming back or it is one-offs.
All right. Sridhar, actually, I'd like to ask you about the margins this time around, because I think that was the other casualty, if I can call it that. So, I mean, of course, you did allude to some sort of, forex losses, and of course, there was some one-offs. So, what were exactly these one-offs, and adjusted for all of this, what would the margins have looked like?
We did an PBT of 11%, PAT of 11% at this point of time. So, but I think if you adjust for these type of one-offs, which is the forex loss which we had, and you could look at it from the euro and CHF appreciation, which happened in the last one quarter, which has been unprecedented over the several quarters, right, was a thing which we had to deal with in this particular quarter. And as you know, ABB follows a very sort of a conservative accounting standards, and we took all the impact on the P&L. So I think that was 56 crores, and the other one-off which we took on account of an project execution topic which we need to deal with was 39.5 crores. And I think if you adjust to this, we are in that range of 12 to 15%, which we already mentioned. So I think
that is the PAT margin, but what about the EBITDA margin?
EBITDA margin 1.5% to that, and we would be there around 16-17% over there.
And Sanjeev, I have to ask you about the robotics division. I know you have given a lot of clarification out in your presentation as well as the press release, but if you can help me with the timeline for that, because the global parent has said Q2 of 2026 is roughly when this sort of restructuring will take place. So is the timeline similar for the entity in India as well?
We take note of the global kind of flow, wherein start of next year, they wish to have a new co established, and I think given if the board finds everything in order in India, we'll try to follow the same timeline.
All right, and I'd also like to ask you about the other segments, right? I mean, if I look at the business X of robotics, only in Q2, the growth was only 4.5%. Of course, there was a decline in process automation. So what is the outlook on all of the other segments going forward? Do you believe that, X of robotics, what would be the kind of growth? Will we see double-digit growth from all of these businesses as we've seen in the past?
I would say compared to last 5 years, there's a relative sluggishness in more market segment relative to what we were experiencing. But we see this is more to be a temporary phenomena. Whether it lasts for 1 quarter and 4 quarters, we'll have to see how it performs going forward. Yeah.
Well, that was the management of ABP India in conversation with our colleague Vamakshi, talking about how Q1 fared and what is the outlook as far as the rest of FY26 is concerned. But we'll now slip into a short break. The management of Epigel joins us next to discuss the Q1 numbers and more.
Welcome back. Let's talk about Epigel. The company reported a mixed set of earnings with the revenues going below estimates, down 7%. Margins remained healthy, in fact, at the upper end of the guided band of 23 to 27%. More importantly, what is the way ahead for the company? We do have Maulik Patel, who's the chairman and managing director, who joins in to discuss more. Maulik, as expected, there was weakness in realizations. What wasn't expected was a decline in volumes as well. Could you give us a sense on what kind of volume growth are you targeting, and at what point do realizations start to turn? Because, prices have fairly seen a big fall. A lot of people do believe that maybe they've bottomed out and from here on we can see an increase. In light of that, what kind of growth or, performance do you expect in the next 3 quarters?
Yeah. So, our revenue at last expansion, what we did in the CPVC as well as in the epichlorohydrin, both molecule are import substitute. And in the major consumption happening in the Q3 and Q4, because during the monsoon time, the consumption of the CPVC pipes as well as the epichlorohydrin, which is a major consumption in the epoxy resin, which is in the paint and coating and the construction sectors, is almost down. And this time, the early monsoon has lowered the demand in the Q1 itself. But going forward, we are expecting H2 will be much stronger because both the products are very strong and the major consumption happening in the H2 in the Q3 and Q4 in this financial year. Volume growth, we are expecting close to 10% in this financial year. And going forward also, we are doing a capex. We are expanding capacity in both the molecules, which are import substitute based on the growth we are seeing in India in terms of the construction, coatings, and the windmill sector. We are expecting very high growth in both the molecules, and our expansion is also on stream and going to be on stream by mid of next year.
So what happens to the realizations? Volume growth, we take your point on board. Second half looks very strong. You've expanded capacity, but realizations, they've been coming down structurally. How long before we see a turnaround here?
Yeah, if you can see that realization is also going down as the raw materials prices are also coming down the same time. That's why if you can see our margin has remained intact irrespective of the realization is going down also.
Understood that. Mr. Patel, at the end of Q4, please correct us if you're wrong. We understand that you are given a guidance, especially for volumes, that it will trend in the range of 15 to 20% with EBITDA margins in the range of 25%. So FY26, are you trimming down the volume growth as far as guidance is concerned to 10%? FY27, post capacity on stream, can you quantify the guidance that you expect?
Yeah, that's right. The chlorotoluene and derivatives, what we have expanded and what we have commissioned by end of March. Normally, that kind of products is mainly going into the specialty chemical, which is agrochemicals and the pharmaceutical intermediate, which is taking little more time for approval of the customers and routine to reach to a initial approval, trial orders, and the commercial quantity will take little more time than what we have thought of. So we are expecting, I think by Q4, we are going to get a volume from the chlorotoluene and derivative business. That's why we have cut down a little bit shorter the volume, but we are expecting the Q3 and Q4. We are very bullish, and we may, the volume may increase in the remaining products.
All right. What about your domestic export mix? You've been saying that you are looking at domestic as your key growth driver. Just spoke about import substitution projects as well. But around 10 to 20% of your sales, which does come in from exports, facing some uncertainty around Europe too. What's your prognosis of growth for both exports and domestic in this year?
As a Epigel, as a company, always focus on the domestic growth, and we have always focused on the import substitute molecule. So our export is hardly 10% of the entire company's revenue. So 90% we are domestic focused. But yeah, in the European segment, there is no change in terms of the export, in terms of the quantity. And we are expecting going forward as a chemical sector is going down in Europe in terms of the manufacturing. They are facing a lot of issues after the energy started facing issue from the Ukraine and Russia war. We are expecting the volume may increase in the European segment, and that's what we see in the going forward.
Mr. Patel, so FY26 capex guidance was 450 crore, which is something that they've alluded to, saying that there will be a few capacities that will come on stream. Going forward, will you go slow on capex given the fact that demand outlook is slightly subdued compared to what you had envisaged earlier?
No, we are going to continuously expand our business in terms of the chlorine derivatives. So we have a land availability in the existing complex, as well as we have purchased a land 2-3 years ago for the future capex. So next 5 to 7 years, we are continuously focusing on the import substitute molecule. We are continuously going to do our capex where the India requires and the import substitute we can able to do it. So that strategy we are continue. Capex also going to be continue. And yeah, so that is we are not going to stop or any full stop in terms of the capex of any and in the future in terms of the volume expansion.
And what about chlor-alkali and specialty? Where do they stand in terms of overall contribution? Where do you expect this to go going forward? Since you have some capex coming in other parts of your business, what happens to this mix?
So this mix as a long term, we have we are going to end up with 70 and 30%. 30% revenue will come from the chloro-alkali, and the derivative segments, it is going to come on the 70%. So as of now, we have reached to 50%, slightly lower than the last quarter because of the price mix. The revenue mix has changed a little bit in terms of the pricing in the chloro-alkali and the derivative segments. But going forward, we are expecting 70% revenue will come only from the derivatives and the specialty chemical. And our capex is also going in that direction only.
Understood that, Mr. Patel. Thank you so much for joining us, speaking to us about how Q1 fared and the plans as far as the rest of FY26 is concerned. Well, as you can see on the bottom of your screen, some time ago, you did see the results of Free Cement. Appears to be a slight miss to what the CNBC poll was indicated, but more on that later. We'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. Let's look at Marico. The company has reported its numbers. Right now, the street was working with a revenue of 3270 crores. The company has gone ahead and reported the numbers of 3259 crores. So largely in line with expectations. Even on the bottom line, it is fairly in line with street expectations. Remember, for Marico, the important part to look at will be what the volume that the company will report this time around. Typically comes about 5 to 7 minutes after the company reports their numbers. So the poll was 495 crores on the bottom line. The net profit 513 crores, largely in line. And we do have, the revenues coming in line as well. We're looking at volume growth at 8 to 9%. Let's see how the company reports. And more importantly, the commentary around margins will be extremely crucial to track. Marico, going into numbers, was at a 52-week high. Post these numbers, which are largely in line, stays around that 52-week high as well. With that, we wrap up on this edition of Midcap Radar. Your stocks when we return. Important show to watch because the markets move to the high point of trade.